Forward. Rakesh Arora, founder with Go India Stocks, joins us now, and we've got Sandeep Kumar, managing director with Tata Metallics, to walk us through what his understanding of the steel cycle is. Rakesh, we heard from Mr. Rao right now, and we got a sense from Mr. Narendran of Tata Steel last week that they do not expect the steel cycle to reverse very sharply. What is your understanding?
Well, see, it's difficult to say anything or add on to what Mr. Shashaki Rao says. He's a thorough, knowledgeable guy on steel. But see, my 2 cents here is that there's a 30 million ton of export of steel which happened from Ukraine and Russia to rest of the world. And if you exclude China, rest of the world demand is around, say, 1,000 billion tons. And 30 million ton is like 3% supply reduction which happened, which led to a spurt in steel prices. Now, the other side of the equation is coming into picture, which is demand. Everybody knows that US Fed is probably slightly behind the curve, and they are likely to, go overboard in terms of tightening. And people are talking about recession in US in 6 to 9 months. Europe, because of the Ukraine war, is already kind of getting pushed into recession. And China, with its zero COVID policy, doesn't inspire any confidence that demand will really, pick up meaningfully. Plus, the housing sector, the real estate sector in China is going through deep correction. Whether people in China would have confidence to go and buy houses is yet to be seen. So demand side, we are seeing that the destruction is happening at a much faster clip. And that is what is getting reflected into, the stock prices right now. The third part of the equation is costs. And here, coking coal prices have sustained at very high levels, whereas steel prices started to come off in line with demand destruction. So margins are getting squeezed. And so overall, when I look at it, I'm really not really too confident that steel would do too well here. The only plus point is that balance sheets have been repaired and stocks are not looking that expensive. So there will be a gradual decline is what looks to me.
Mr. Kumar, what is your sense? What is the ground reality?
Yeah, good morning. Yeah. So I think, very valid points mentioned that there are issues, there could be some issues on demand coming from China and, possible degrowth in some of the mature economies. But this is, currently whatever you're seeing in the world, especially in the last, couple of years, is a post-COVID, is essentially a supply-led inflation. There is a major supply shortage, across commodities. Let's say if we talk about pig iron, which is what Tata Metallics, produces, or ductile iron pipe, especially in pig iron, virtually 50% of the world's, seaborne or other trade, international trade, has been wiped out, from Ukraine and Russia. Now that's led to a massive exports, build up from India. So if you look at some, figures, if we were exporting, India was exporting roughly about 50 to 60,000 tons per quarter. Now they've booked almost 350,000 tons in the last 2.5 months from February onwards. So that's absolutely massive. On steel, I think there are other players who can talk more about it, but I think there is some linkages. Yes, raw material prices have, been up and down. But coke has softened a little, iron ore has softened a little, but coal came down and then went up again. So it's still a little uncertain on the raw material front, and therefore the sentiment may not be, as negative or as clear as it might sound at the moment.
Rakesh Arora, if I can come to you, and just taking forward this conversation, the fact, however, is that the world's largest consumer of metals, China, we still don't know what's going to happen with growth, Shanghai-like lockdowns in other provinces as well. Nevertheless, the way steel prices are going down, aluminium is down 30% from the highs. My question is very crude. Have metals topped out?
You're asking me?
Yes.
Sorry. Okay. So see, metal stocks have kind of peaked out for the moment, and they're already on a declining mode. We have seen sharp correction in aluminum stocks. Steel companies were already going through a time correction because steel margins came under huge pressure because of coking coal prices. And but now also steel stocks are also declining slightly. But as I said, valuations are on their side, so I don't see massive declines. Usually what happens is that these stocks trade between 0.5 price to book to 2.5, depending on the balance sheet situation. Now balance sheet is strong, so unlikely they'll go below 1 time book. And secondly, even currently the margins are very high, meaning the long run margins for steel companies like JSW, historically they've done like 8,000 rupees per ton. They are doing 20,000. It's too high. So still the profitability is too high, and I think stocks will sustain slightly better valuation, more so because there have been structural changes. China, which used to encourage exports by giving export duty drawbacks, they have removed all those incentives. So around 13% reduction in incentives have happened on steel price, which is going to reflect in long run margins for steel companies. So from historical to now, probably steel companies will be valued at a much higher margin and higher valuation. But as I said, the current margins are way too high, and there is enough scope for these margins to correct to nominal levels once inflation or the growth declines, etc. And when margin are declining, I don't see stocks can perform against that. So I'll be a little bit cautious on the steel stocks here.
Okay, so you would be cautious. You raised a fantastic point as well. We have to wait for things to normalize. But till then, what we've also seen is that, like you pointed out, steel companies have made, I've seen a big bonanza, Rakesh Arora, profits, the kind of margins that they've done. But they're also running almost at peak capacity. They're making cases for importing cooking oil, coal. They don't want to do that anymore. They're making a case to the Prime Minister. We've read those interviews and things like that. What are you expecting from these steel counters? Diversification, capacity addition?
See, steel companies have made money and they will expand. Meaning it's just a matter of time. JSW has capacity coming up, but see, everybody is going to expand. That is why it is a cyclical business. Most of the companies tend to do expansion together. But in any case, India doesn't matter much because India is a minuscule proportion of the global trade and global demand. So our demand supply balance doesn't really change much. It is China, which is the big brother, so China's export have been kind of static at the moment at around 60 million ton per year. If China was to export a little bit more to support the domestic economy, I think the correction in steel prices would be much faster than what we are building in right now. So China is the black box. I don't know what's happening there in terms of lockdowns and possibly exports. That is what is going to really define, how steel stocks trade. Valuation-wise, on current margin, they look cheap, but there's a possibility that margins can erode.
Kumar, you spoke about the impact on the kind of uncertainty that we're seeing in terms of pricing, the Russia-Ukraine conflict impact. But what about with the China lockdown intensifying in terms of, whether or not you see this as a temporary phenomenon, or do you think it'll fade away by the time we see the next leg of the commodity upcycle beginning? And what would be the impact?
See, Chinese government has come out with the target
Rakesh,
of
actually, that was for Mr. Kumar.
Okay, sure.
Sorry, yeah.
My apologies.
Yeah, okay. So, the fundamentally, I think what we believe is that this Ukraine-Russia conflict has created a structural problem. So, as rightly mentioned by Rakesh, that it's a cyclical industry. But right now, what's happening, it's more structural. You have a lumpy capacity going out of the market from Ukraine and Russia. And that's massive, both for steel as well as for pig iron. And that's where the impact you are seeing. Now, how long it will continue is difficult to predict, but generally speaking, the sense is that this is going to be there for maybe at least a couple of years, if not more, because sanctions are going to continue. Maybe there might be some negotiations and things might roll back to some extent. We don't know. But Ukraine's capacity is damaged. It's actually devastated. So that's out. As far as China is concerned, there's also the factor of strict emission norms. China is undergoing again another structural change in its steel industry, and it's going in for much stricter emission norms. And there's also the decarbonization initiative by the government of China. All this is going to make Chinese steel and Chinese iron and steel industry much less competitive. So all the exports that you have seen in the past is unlikely to happen in the similar fashion as what we have seen in the past. I think this aspect also needs to be understood. So what I've been reiterating is that the supply side on the international trade is what is going to be impacted. Yes, demand is also, is something which we'll have to see how it pans out, and there are concerns on that. But supply, there are chunky capacities, lumpy capacities which are getting out, and that's what is going to be, see the pressure on the prices as we go ahead. Yes, there will be some fluctuations. There will also be the impact of raw materials. But coking coal, you mentioned, coking coal primarily, seaborne trade comes from Australia. There are three countries, Australia, Canada, and to a certain extent, US. Russia is not a big exporter of coking coal on the seaborne side. Okay, so the impact of Russian coking coal is not going to be that massive. But if Australia goes out, that's a massive one. So we just need to appreciate and understand the difference, how coking coal, which is a major contributor of costs for the steel industry, is playing out here. So I hope I've been able to explain a little bit on the dynamics.
Yeah, you certainly have. And Mr. Kumar, staying with you, we have seen that over the last 3 to 6 months as well, the DI pipe prices, they've seen quite a healthy uptick of 50 to 60%. What is the outlook when it comes to the ductile iron pricing? Are you seeing a softening that has started playing out?
Not at all. In fact, what we are facing is an overhang of the old prices, because typically the ductile iron pipe contracts are for, let's say, on an average 12 months. So we had, let's say, for 12 to 18 months. So you haven't seen the margins playing out in our results because we are all having old contracts and we are still honoring them. But now, as over the last 1 year, as we have been booking new contracts, the prices have moved up by almost 50 to 70%, and very rightly so, because the raw material push has been there. So we will start seeing this reflection in the ductile iron pipe margins as we go forward. Yes, Q1 is a tight one because of the impact of a significant increase in coal prices in March, which will play out in the, let's say, in this quarter. But otherwise, as we go forward, I think the raw material, getting more stabilized. If you look at it, iron ore has marginally reduced over the last couple of months. Coke has also marginally reduced since last 1 month. Coal has been up and down. It went up to $670 in March, came down to as much as $470 in April, is again up to about, let's say, average about $510 or $515 this month. So it's been a roller coaster ride for coal, but other commodities are more or less either, slightly softening mode. So the cost wise, I think definitely the industry will have some impact in Q1, but price wise, I think on the finished goods, we should continue to see, I would say strong prices, though they might be some range bound, and there are concerns from the demand side, which I appreciate. But generally speaking, the prices of ductile iron pipe remain very strong, driven by the government investments on Jal Jeevan Mission. The Jal Jeevan Mission, the government wants to complete the projects by next financial year. So we have 2 years to complete. They had almost 90,000 crore of investments. They've hardly spent 20,000 crore last year from the center. And that's because they say COVID and also because of prices. I would assume a lot of this would stabilize this year.
Appreciate your time, gentlemen. Thank you so much for throwing more light on the picture of where we're seeing these commodity prices headed, the outperformance within the metal sector, the impact of the geopolitical crisis, as well as China.